guys? My name is Chris. This is Wheelhouse Trading, and welcome to the Wheelhouse. Okay, so I'm going to drop one on you. I usually do these kind of informative topics and things of this nature in the courses. If you're interested in learning how to navigate the markets, get out at tops, find bottoms, short markets, breakouts, day trading, advanced day trading, crypto, dollar cost averaging, chart patterns, technical analysis, how to short market phases, just everything, trading psychology. Click the Discord link in the description below. And don't forget that Wednesday, December 22nd, I am going to teach upgraded and non-upgraded members that enter the Discord and are in there. I'm going to do a group training. I'm going to teach you how to compound your money, just like when I took 10,000 and turned it to 170,000 on Bitcoin, or made 128% on Apple. You got to go up, you got to go down. I have a specific way to compound, a specific probability system that I use, and let's move forward. So I hope everybody's having a good day. I'm going to put out this video. I want to share with you because I care about people, and I happen to know a little bit about stuff like this. As you guys know, I have a finance degree. I've been big in economics and was a CIO of an investment firm, and also, built 3 major companies, was the CEO of 3 global empires. I retired. But during that journey, once upon a time when I was 28 years old, I'm 44 now, I actually lost $10 million of my money. And when did I lose that? Well, I lost that in a recession called the financial crisis of 2008. I was a home developer and was not able to sell my homes. Nobody could get loans. Values were plummeting. It hit the fan. It was bad. At that time, I had multiple homes, cars. I was doing very well for myself at a young age, but I was too young to really understand how bad a recession could be. People lost their homes. There was divorces. Children were separated from their families. People, lost jobs. Businesses closed down. Certain industries were hit. And of course, the stock market crashed. And it wasn't a correction. It was a crash. And it disrupted the global economy. So in this video, I am going to teach you guys some things to help you out. And like I said, I normally wouldn't do this just on YouTube. This would be more for, our Jedis in the Discord, and you get all the courses. And there's just so many of them. It's so deep, so thorough. I mean, it's just like serious. I mean, people love these courses. They're learning so much, and I'm expediting their experience, their trading and investing journey in light speed. Compared to, you're coming out of there basically with a PhD in finance from Harvard by the time you're done with this, and it's only $99 a month. Plus, you get the group trainings, the whole Discord's open with all the other Jedis, and you get the one-on-one coaching with me. You get 10 hours of that. That's really cool. It's private, just you and I, and you get all the trade alerts. The trade alerts itself is sick. You don't win them all, but I win a lot of them. So. Really good. So look, I'm gonna teach you guys some ways to spot market tops, what you should be looking for. I know not everybody really knows a lot of technical analysis. There's many different indicators that have started a bear market, or there's ways to notice tops in a chart, just like there's ways to notice bottoms. And I can't get into everything, but I'm going to give you some serious tips. And I know a little bit about this, so yeah, let's just talk about it. So the first thing, I made some notes because this is quite a topic, and I want to be kind of clear with everybody. So look, identifying tops is critical, and one way that you can do that, one very simple way that you can do that, everybody can do it, is you get a chart. Don't worry about anything in the chart. Of course, we're going to talk about volume and distribution and follow-through days and all this stuff. But let's just imagine that you just had the MACD, because a lot of people know the MACD. Okay, simply on indexes as well as Bitcoin, because Bitcoin is like the Dow of crypto, you could simply just, when the MACD crosses right here on SPY, well, it's safe to enter. It's safe to enter because the blue line is crossing. And then when it crosses again, but you need to see a little black line. When it crosses again right in here, you need to get out, okay? And you can do that on all of them. That's a very simple way. It's not the absolute tightest way, but it is going to save you some money doing that, okay? So the MACD on the indexes, as you get in, as you get out, you skip all that, okay? Now, moving forward. So now that you know a way to identify that on the indexes, which are the umbrellas where all your stocks and equities are, now you need to understand what goes in those indexes, okay? So you know that the NASDAQ is tech, it's information tech, it's biotech, right? So if you see that the NASDAQ is good to go, well, hey, load up all your tech stocks, boom. But when the MACD comes back down, you need to abort. You need to take your profit, raise cash, and put it on the side, okay? It's just how it's done, all right? Now, the reason I want to teach you that basic thing is because if you know how to identify tops, then you can save your butt a lot in the stock market, crypto market as well. So if you see that happening, a lot of people will say, well, it's only gonna come down a little bit, and I'm a long-term investor, and I'm gonna stay the course, and you can do that, and I can give you a whole bunch of reasons why that's probably not a good idea. Look, you don't know if it's going to be a 3% drop, a 5% drop, a 10% drop, maybe call that even a normal correction, but you also don't know if it's going to be a 25% drop, a 35% drop, a 50% drop, a 90% drop. And believe me, there has been 90% drops. There has been 50% drops, okay? So it's always best to enter in properly and exit for safety. Put your cash on the side, raise cash, and then when it comes down and the coast is clear, put it back in, and guess what? Buy all your same stocks at the bottoms, okay, technically, and then compound it. And so you ride it all the way from here to here, get out, wait for it to hit the bottom, ride it all the way up, get out, and you just, at the end of the day, you're gonna have more shares, you're gonna have more money, okay, if you do that. That's the G way to do things, all right? So you don't know how far it's going to drop, all right? That's number one. Okay, so knowing that, it's critical to your success as an investor, and this information is just as important to a swing trader and day trader, although a trader may find benefit in going short and find ways to capitalize on the markets coming down. Now, like I said, the hardest part is knowing if it's going to be a regular 5 to 10% correction, or if it's going to go much further. And that is why it's good to have a system and a process, stick to that plan, basically. Some people's plan is to, let's grab a stock just real quick and I'll come back. We'll just grab any stock. So some people might have a plan to, that's not a good example. Here's a better example. So some people's plan might be to just buy in if you can see the red, to buy in and stay in until the ribbons go blue, okay? It's a good plan. You're not buying forever, which is good. You never want to hold forever. You want to enter technically, and you want to catch the whole run and then get out technically. If you hold forever, you're going to go through these major damaging situations, and if you're in margin, you could get really messed up. If you go down 20% and you're in margin, that means you lose 40%. If you go down 50%, that means you lose everything, 100%. So you need to have a process. You need to have a plan. You need to have a system. And that's where I come in, and I will help you. I promise I will help you. Click that Discord. We'll talk. You don't have to pay for anything. It's free to come in the Discord and meet everybody. You can ask about me. You can ask about the courses. I really think it could help you because it's going to be a little tricky next year. And I possess a lot of information and experience on the markets. So if you're looking for somebody to talk to, you've been losing money, you need some help, definitely click that Discord link, okay? Now, another system might be simply to buy in on the 200. When the 200 crosses, and you stay until it crosses the 200, because above the 200 is bullish, below the 200 is bearish, right? Okay, there's all kinds of systems. Okay, people seem to, over the years, when they get in the market and invest and trade, the biggest flaw that they have is changing systems. Okay, I'm a long-term investor. Now I'm a trader. Okay, well, this guy said, buy the dip, and I didn't know I was supposed to do it technically, so I'm averaging down, and I've been doing that to the point I have no money left, and I'm still going down. And, look, you got to have a system and a process, and part of that system needs to not be married to a stock, be able to execute immediately without emotion. And when I say immediately, I mean without a limit order. You're not looking for 0.8 of a point to save. You're looking to execute in a market order and sell and pull your money to the side when it hits the fan, okay? And you can have stop losses and protection protocols already in there. One way to know that if things are not going right is you're taking a trade perfectly and you set your stop loss accurately and you're getting whipsawed out and you're getting stopped, okay? That tells you the market's not right. Another way is if your last 5 things that you bought for your portfolio are all down and they're not making money, that's another telltale sign that the market is not right, okay? So what I want to teach you is how to identify bottoms, how to identify tops, and to be able to get out at the top, and then you can basically skip all the stress, skip the heart attacks, skip everything, establish a floor, find a follow-through day, keep an eye on volume, and then you can re-enter safely and get out if you need to again, okay? That system, that process is going to make you a lot more money in the long run than just waiting it out. Waiting it out is for the investor that isn't really that skilled. They don't have they don't have the attributes or maybe the mentality to really be able to handle the trade management, the position sizing, and the protections that are built in. I mean, I'm not trying to talk bad about anybody, but honestly, if you want to really make it and you want to be a multi-millionaire, then you need to understand market trends, market phases, market cycles. You have to understand entries, exits, capital protection. You have to understand how to go short. You have to understand what moves markets, what has caused recessions, what has created bull markets, what's a leading indicator, what's a lagging indicator, when this happens, does this happen? You got to understand that stuff, okay? Now, in this video, I'm going to teach you a whole bunch of things that you might not know that are pretty important to look for as identifying indicators that we may be at a market top or entering a bear, or worse, the beginning of a recession, okay? Now, before I do that, I just want to tell you, look, if you're new to the markets, okay, crypto or stock, okay, first, you lose money, okay? That's because you don't have a system. You don't have a process. You don't know about entering on the ribbons or the 200 or getting out at the 50 or buying bounces technically. You don't know. You're still learning, and that's okay. Everybody has to learn to find out, are you a scalper? Are you a day trader? Do you prefer crypto? Are you a swing trader? Are you a dollar cost averaging? Do you want to do technical analysis? Are you fundamentally driven? You have to figure out who you are. So at the beginning, you lose money, okay? But then you start getting a process. You start finding out who you are, and then you lose less money. Wait, Chris, first I lose money, then I lose less money? Yeah, buddy, that's how it goes. You're making progress. Then you get even better because you became a Jedi in my courses, and then guess what happens? You broke even. You got better. That was after the first month. Then after the second month, guess what happens? You started making money, okay? Then you became a rooftop ninja assassin like me on the Jedi Council. You slay Sith Lords all freaking day, and you kill it. You crush it. You can literally make millions of dollars because you know what strategies work for you. Are you a gap up trader? Are you a breakout trader? Are you an intraday VWAP trader? You know, are you looking for low float? Like, you're going to figure out who you are, and then you're going to make money. So first you lose money, then you lose less money, then you break even, then you make money, and then you crush the game, son. Okay? So now listen. It's important to know at the tops, you need to move the money to the side. And you need to get out of margin immediately. Get out of margin immediately, okay? When you see markets topping. Now, it's safer, okay? It's safer on the side, and it also benefits you because your peace of mind, your health, and then when it does come down, you don't know how far it's going to come down. That's opportunity, okay? You're going to make a lot of money. If there's a recession and you got a few mil on the side, and the housing market crashes, and then you come in and you swoop up, you know, like a $2 million house for 750 grand, and maybe pick up a couple rentals for 250 grand off of each of those, and then, you know, then you can buy into the bottom of the stock market right before it's going to rally. You're going to clean house. You are going to clean up. So you need to have your money, because you can't make money unless you have money. And if there's a recession, there's not a lot of jobs. And you have to be skilled, highly skilled at something to get one of those jobs, okay? It's very tough in recessions. I'm not saying one's coming. I'm preparing you just in case. Now, so you want your money because you got opportunity. Now, speaking of money on the side, guess what? I read a report at $4.7 trillion as of Friday at close has been moved to money market settlement funds. So institutions, funds, hedge funds, 4.7 trillion, almost $5 trillion has been pulled out of the market in the last couple of weeks and put to the side. Why do you think they're doing that? Why do you think they're pulling it to the side? Why do you think I've been saying it for a month on this channel? Why do you think I've been trying to tell you guys, like, you got to put money on the side. You got to identify a market top. You got to compound. That's why I'm doing the training. I'm trying to give you that Christmas gift that's going to last you for the rest of your life in the Discord link below. Okay, $4.7 trillion on the side. Does that tell you something? Okay, now look. Now, when the market does top, of course, you want the discounts of your favorite stocks. Like I've been saying, build a watch list and wait for bases to form and things like that. And I can understand that. But you need to pay attention to certain things like the volume and a follow-through day. And you do that for safety. Especially right at the pivots, so what is a follow-through day, Chris? Okay, well, let's go find a follow-through day. So a follow-through day is like, you're getting green volume. It's you're on a rally. The volume's increasing while the price is increasing. It looks like something like this. Okay, there's a follow-through day. So back in here, when we had that big February 12th to May something. Oh no, this is November. Sorry, this is the crash last year, September and October. So right here you had the rally, and then you had this big volume was a follow-through day. That indicates the beginning of a nice rally. Now, what does a distribution day look like? It's tricky, okay? Also, huge volume, but look at the candle. It closed in the green, but barely, and it went up and then sold off on the day, and it's a very tiny candle, but the volume is really big. Now, I'm going to tell you guys some things you probably don't know. There's going to be some people out there that know a lot. They're going to be professional portfolio managers. They're going to be fund managers. They're going to be, manage billions of dollars. Maybe they've been in the market a long, long time. There are some channels out there that are like really like top tier, like traders and trading channels, and there's some pros out there, but then there's a lot of like newbie channels that really just don't know what they're talking about or what they're doing. So I'm gonna go through that just in case you don't know some of this stuff. Okay, so volume and follow through day is super critical. You don't want to jump back in too early. Okay, so when you see it fall down, you certainly are not averaging down, and you don't want to buy right on the pivot. You want that follow through day for safety. So don't jump back in too early. Make sure you get out the top, you get out of margin. Okay, these are critical things. Raise cash to the side. You need money to make money, right? Just kind of reiterating. Let me read real quick what I got here. What you're looking for is a directional change. So right now in the markets, things are kind of, they're way up, they're way down, they're way up, the volatility is very high, it's very erratic, a lot of rotations. Yes, we had quadruple witching. We had the Fed say they're going to speed up tapering, interest rates, you got Omicron, all kinds of weird stuff going on, supply chain shortages, political stuff. It's just, yeah, it's just out of control. So we need the market to find a direction. It looks like an M is forming, and it is a lower high and possibly a double top. Those are all bearish. Everything does not look very good, and I've looked at all the indexes. There's a lot of indecision. Nothing is showing bullish. So we don't know if it's going to be rallying up or rallying down. It's indecision. Therefore, you need to be careful, not jump in, not go deeper into margin, play it tight. Remember, there's always another trade. There's always another day. But you need to understand the trend. Is the trend going down or is the trend going up? You don't want to trade when it goes sideways. You want to trade with the trend, okay, up or down. So we're waiting for the market to find its direction. Okay, now as far as a directional change to the upside with a confirmation, which we call a follow-through day, that usually will happen in the first 4 to 9 days of the rally. So you want to look out for that big spike in volume going in the direction of price action. It's usually on the 4th day, the 7th day, or the 9th day. I can't remember why that is, but that's how it seems to work. It's like maybe the institutions know that too. I learned that from one of the OGs of Wall Street. So let's see. All right, so okay, I already went through that. Okay, so let me just explain something really quick. So when you have big volume up and the price is not really going up very much, or it opens high and closes low, these are signs that you're coming to a top and you're at a faulty market fake out, basically. Okay, all right, that's one thing. Now, bull and bear markets do not end easily. They can take time. Okay, now check this out. As an example, and I don't believe this is a good example, okay? But as an example, you may be feeling it in December, but actually the beginning of a bear market could have started much earlier, depending on the volume and distribution and things of that nature. So, you know, this is COVID, you know, this is February through May. Oh no, wait, hold on. Oh no, this is last year. This is that dip last year. This is the February, April, May. And then you got this one that we just had, and now we're having another one. So there's a few ways to identify, okay? Every top has 2 to 3 major pullbacks before it tops and collapses, okay? They all have these big pullbacks. So I would say that this is 1 and this is 2, okay? 2 to 3, okay? And they're closer like that. All right, now, what happens during this is funds will sell off, okay? It'll create distribution days. And then additional funds will go, and then algos and quants will be tied in, and they'll start to sell. And then what happens is it shakes out weak hands. Well, you can say weak hands, you can say whatever you want. I don't really care. I just care about my money, and I just care about exiting at the top and keeping all my money. While everybody else is freaking out and in pain and throwing in the towel and being shaken out, I'm just ready to kind of come in and get it all at the bottom. And that's what I'm trying to teach you. I'm trying to teach you the G method, how to be a G, okay? So in order to do that, you have to understand what to identify and how to get out at the top. Okay, so you know that there's 2 to 3 pullbacks before a top. You know that there's distribution days that start showing up like here, okay? And then you know that there's going to be a big shakeout, okay? And then what ends up happening is so many people pull out money like the 4.7 trillion to the side plus the shakeout of the retail investor that nobody can hold up the market in that direction, and unfortunately it tops and goes in the other direction, and then you start a new market cycle. Okay, now it does take some time. It doesn't just happen like all the way to the top and crash. Okay, like an OTC penny stock, it's the indexes will, I mean, they're going to go through like what you're seeing now as an example. Look, one way to spot market tops or a market crash is diverging macros. I still don't know anybody on the news or anybody on YouTube that's been talking about diverging macros but me, and I did that like, I don't know, 3, 4, 5 weeks ago. So look, when everything is diverging, okay, you got stuff moving from the Dow to the NASDAQ, from the NASDAQ to the S&P, or the S&P back to the NASDAQ to the Russell, like diverging. They're not all going in one direction, up or down. They're diverging. That is an indication of, sometimes it's an indication of rotation, but it's also an indication that happens before market tops and the end of a bull cycle, just so you know. Okay, so like many bear markets started with economic tightening, and that tipped us into a recession. I'm going to talk more on that. But also things like the Vietnam War, the Clinton era, Y2K, like catalyst, basically, catalyst, okay? So you got diverging macros, you got multiple pullbacks, you got distribution volume, okay? And so far you have that, okay? And of course, economic tightening is a huge one. It's actually been pretty much the precipice of most recessions, to be honest. I'm going to get into that. I'll tell you about Alan Greenspan in 1987. I'll tell you about 72 through 74. I'll tell you about 1981. I'll tell you all about it. Okay. So another way that you can notice that you're at a top and you're ending a bull cycle and going to a bear market is when the leaders of that year or that bull cycle are acting abnormal and they're not holding up anymore. And then at that same time, another thing is the small caps that have been failing through the year will actually try to rise up and flex and be the top dog, but if the leaders can't hold it up 100% of the time historically, those little ones that tried can't hold it up either, and they all come crashing down. Okay. So, are leaders acting abnormal? Yes. Has there been multiple pullbacks? Yes. Is there distribution? Yes. Is your indicator showing strength on any of your macros to go up? No. Do you have a fall-through day? No. Okay. So, we have symptoms. We have symptoms of being at a top. Okay. Now, here's the doozy, guys. Any change in the Federal Reserve Board rate change, okay, now this is a big one, because interest rates have always been a confirmation or a benchmark for how the economy is doing, okay? I had to write this down because I have so much stuff in my mind. So Fed fund rates or discount rates, okay, you always got to pay attention to those. Those are major indicators. And they have been, like, literally have started recessions, okay? And I'll explain a little bit more so you guys understand. Look, like, here's a little fun fact for you, okay? Throughout history, anytime that the Fed has come out and either raised the rate 3 times in 1 year or announced that it will, sound familiar? Listen to what I'm saying right here. Any time in the past that the Fed has come out and either raised rates 3 times in 1 year or announced that it is going to raise it 3 times in 1 year, generally that was the start of a bear market and impending recession. And unfortunately, I am not making that up. That is a historical fact. So Jay Powell and Biden just came out and said, we're raising rates 3 times in the next year. And historically, any time that rates have been raised 3 times in 1 year or announced that they would be, it was the end of a bull market, the beginning of a bear market, and the beginning of a recession. So, now I want to level with you. Well, Chris, why would they want to start a recession? Why are they doing this to us? Well, I'll explain it to you. The Fed got themselves in a bad situation. Okay, there was a pandemic. They had emergency acts, emergency uses, emergency money printing. They printed a lot of money. They propped up the market. Okay, they stimulated the market. They made people stay at home. They sent them checks, and those checks went into the market. It propped it up. It inflated it to no end, and we had a raging bull market of 2020. Okay, now the money printer is still going with $3 trillion going into an infrastructure bill and different things of that nature, but they're in a tough situation. They can do one of two things. So the first thing that they can do is they can raise rates to combat inflation, and that will create a stock market crash and possible recession, especially when coupled with slowing growth. Okay, this is like historical, factual, stuff. Okay, now the second option that the Fed has is to keep the rates at zero and let inflation run wild. But if they let inflation run wild, then the US dollar becomes weaker, and they, meaning the United States, runs the risk of losing the world reserve currency. So what do you choose? Do you choose crashing the stock market and going into a recession with a framework that now has a higher interest rate? And by the way that most recessions end is by the Fed lowering the interest rate. Okay? So number one, you raise rates, create a stock market crash, create a recession, but have a card now, because right now they have no card. They're at zero. They can only go back. They can only do where they pay you to borrow money. It's called negative interest. It's not good. So they don't want that. So they got to build a framework. They got to raise the rate, crash the market, and build a recession in, or they can let inflation run hot, let the rate stay at zero, and possibly lose the world reserve currency. So the lesser of two evils is to crash the market. And it might not do it, okay? It might not crash the market. It's just that historically, just about every single time in history, it might be every single time in history. Let me see. Hold on, I'll tell you. I have every collapse, every reserve board, data change. Okay, bear markets have usually but not always ended when the rate was finally lowered. Okay, so that's coming out of a bear market. As a rule, interest rates provide the best confirmation of basic economic conditions, and changes in the discount rate and the Fed funds rate are by far the most reliable. In the past, 3 successive significant hikes in Fed interest rates have generally marked the beginning of bear markets and impending recessions. In 1987, Alan Greenspan increased the discount rate to 6% in September, and just after the market broke in October, 1 month later, to a bear market, beginning of a bear market. All right. This stuff is real, man. I'm giving it to you real. Somebody hit me up today. They're like, I love your no BS approach on your channel. And he's subscribing. Like, that's the deal. Like, I'm not here to BS you. I don't get paid from this. I'm already wealthy. Like, I'm already good to go. Like, I'm doing this for free, doing it for you. So click the Discord link, get in there for free. Let me teach you how to compound your money and literally make a lot of money. I'm going to teach you how to do that. I'm going to teach you how to get out of the top. I'm going to teach you how to stay away from all this drama and all this pain and get out. And don't be that guy that's got, 3 jobs and, asking his mom for money and got a baby crying in the corner. You gotta, be ready. You gotta have your head on a swivel no matter what. A lot of these guys on YouTube, they've never been through a major market crash. They don't know what that's like. They don't know. They're too young, So you gotta, pay attention to some wisdom and some experience here. This is important stuff, guys. In 1981, a recession and bear market started solely because the Fed raised the discount rate 4 times that year. Yeah, yes, I know that one. Okay, so look, the taper's being sped up, interest rates raised. The Fed. I already told you about the 2 options, basically. Now, here's some things that you have to look for in market tops. We talked about the multiple pullbacks, 2 or 3 pullbacks. Okay, we talked about distribution volume. We talked about leaders not leading, and then small caps trying to come up and flex, but they will always fail, like 100% of the time, when they try to do that under these conditions. Okay, only under these conditions I'm talking about, not like in any other condition. Okay, now when railroads and heavy equipment manufacturers start doing really well, that's the end of a bull market. Okay, so when railroads and heavy equipment manufacturers do really well, that's a telltale sign of the end of a bull market. Okay, always has been, and seems like it just always has been to date. Okay, when lowest PE and speculative small cap companies attempt rallying, flexing on the market, you better believe we're at the end of a bull market. So if you start seeing all these people talking about buying, small cap and low PE, brace yourself. Brace yourself. Now, you guys got to know that the stock market's like a leading indicator, okay? So when you're going down into a bear market and a recession, businesses are still coming down, right? But there will be a bottom and the indexes will start coming up, okay? Like an indicator that is leading, not a lagging indicator like a moving average, but it will lead us out of a recession. The indexes will also lead us, it'll start going down before a recession, and it'll lead us out. Also, in the Dow theory, there's some major things. Trade with the trend is one, everything is discounted as two, and it is a barometer of the health of the economy. So if the top 30 companies, most influential companies that are in the Dow have a problem or something is wrong with the economy, it'll show up in the Dow, and it also shows up in other indexes. Now, so look, basically, you got more symptoms. You got small caps, you got PE, you got railroads, you got historicals. Everything is kind of matching. What you got to know is there's about 10,000 institutions. Some of them are charitable, educational, pension funds, insurance funds, hedge funds, institutions. All kinds of big money out there, right? And the consensus usually prevails. Okay, I think there's a thing about that it's out of 10, it's like 0.1 0.01 of 1% is wrong on the consensus of institutions, and the market will be right. So if everybody's pulling their money on, everybody's putting it to the side, and historically, when rates are announced in the same succession that they've been announced, it's always ended up in a bear market. And the Fed is in a sticky situation, and the economy is slowing, and if the economy is slowing, that creates recessions. And you hear Kathy Wood saying we're going to recession. You hear Bill Ackman saying I'm shorting the bond market. Michael Burry is shorting the bond market. Okay, I'm probably going to short the bond market. So I mean, look, you have okay. So look. You got all these hedge funds and institutions, and they come to a conclusion and create a consensus, and they will create the direction, whether it's up or down. Now, I mean, honestly, look, the trend is strong, the ribbons are strong, everything looks okay as it is. So it could rally on further. It could do this and then come down and rally a little bit, but maybe not too high, and then have another pullback and then fall. I mean, if this is number one and this is number two, I mean, you're looking for 3 or maybe 4 at the tops, and I don't think these ones way back here qualify. So, I mean, it really needs to break that number. Look, in 1973 and 74, it was a 2-year horrific bear market, and it was because of 2 catalysts. First, there was the Nixon-Watergate scandal that was televised on TV. And second, OPEC, there was the oil embargo initiated by OPEC at the same time, and it freaked the market out. Right before that, in 1969, you had Vietnam, you had inflation, and you had hawkish Fed tones and tightening of Fed policy. And there you had a bear market. Okay, So yeah, look, you don't want to be devastated. You don't want to be like long-term hold in a crazy, crazy time. What you want to do is have your money on the side and be long-term, but wait for it all to figure out whatever it's going to do, and then get in technically and ride it all the way to the top for 2.5, 3 years, because that's how long bull markets usually last, is about 3 years, and then they go down for about 3 years. That's on average, okay? Sometimes they're longer, sometimes they're shorter. I mean, there's been some long ones out there, but that's the average. So, so back in 1973 and 74, when they had that Watergate scandal and the OPEC situation, it was so catastrophic at that time that it was the second worst crash of the stock market next to the Great Depression. Just so you know. Yeah, and then I told you about 1969, 1970. That had to do with inflation and a tight money supply while being at war. Trifecta, a real bad one. Now that one, the market dropped 37%, okay, on the indexes. However, the stocks averaged a loss of 70%, where a lot of them were at 90%. Okay, and the other one, and I think it was 1981, with the Fed raising the rates, the Dow, I think it was 81, the Dow dropped 50%, and most stocks lost 70 to 90%. I mean, look, companies like Coca-Cola, Gillette, and Yahoo and AOL were the hugest leaders, went up thousands of percent. They got knocked in the dirt 90%. So, it's just critical to understand all this. Am I saying there's a recession? No. Am I saying we're in a bear market? No. Am I saying that we're going to crash? No. There could be a Santa rally right around the corner, baby. But I want you guys to understand how to spot a market top. Look at volume. Know that if railroads and heavy equipment are going up, understand that Fed rates and tightening in a certain sequence has always caused a bear market. Notice that when they're tight like this, just start looking at all the different things together and ask yourself, do we have symptoms? Because if the indexes fall, then the housing is going to fall right behind it. And if you lose your money and don't pull it to the side of the stock market, and then you go to sell your house, but everybody's trying to sell their house because they have a loan, and everybody's undercutting the value of the house, and before you know it, you can't even sell it for any profit. Now you have no money in the stock market, no money in your house, and you can't even, you've got to go BK or take a foreclosure on the chin. You don't want that. So you need a system and a process and a coach and somebody to talk to. And let that be me. Let me help you. I can navigate this stuff. I've been doing it for a long, long time. I know how this stuff works. I know the ins and outs of the markets, and I'm trained like they're trained on Wall Street. I understand this stuff, okay? So yeah, just be careful. Don't buy too much right now. Don't be deep in margin right now. Wait for a verification, a confirmation. Wait for follow-through days, and then you're good to go. You're good to go, because markets can be erratic. They can still go up. It can go up. It can go up for another year. It can go up 2 years. I don't know. But, when I look at everything that's happened from the pandemic to the money supply and all the printing and now the inflation and interest rate hikes, and I'm seeing what's going on with the volatility and the volume, and I'm seeing indicators and patterns and things that happened in the past, in the financial crisis, the .com. I'm just seeing similarities, and they're pointing towards maybe not a red flag, but probably not a yellow flag. Let's call it an orange flag. We got an orange flag on the field. We're gonna say that that's a 5-yard penalty. Actually, you know what? Let's give it a 10-yard penalty, so you take it serious and you don't do it again. And do me a favor, hook me up. I keep it real. I'm telling you straight up what's up. And I will be there. I will talk to you every day in the Discord. If you just join it, you can just talk with me and all the other Jedis, and everybody's cool in there. We got the crypto chat, the stock chat. When you upgrade, you get all the other areas. We do sick group trainings where I just take you to the next level on stuff. So yeah, join the Discord, hit the subscribe, hit the like, send me a comment, shoot me some love. I'm hooking you up, trying to help you, and I'm going to teach you December 22nd, Wednesday night, 6 p.m. in my Discord, in the Wheelhouse Club. I'm going to teach you guys how to compound your money. Even if there's a crash, supply chain shortages, none of it matters. Doesn't matter if we have political issues or trade tensions, none of it matters. All that matters is my system on how to go up and how to go down and how to do it exactly like I say to maximize your gains, and you will love it. So click the Discord. It will be free. If you do want to upgrade, that would be awesome, and you can find that under frequently asked questions. Thank you so much for watching. I hope this helped, and I hope that you kind of ingrain some of this stuff in your brain, just to what to look out for, market tops, what's caused bear markets and recessions in the past, and what to look for, just in case. You know, they don't happen often. They happen about every 3 years. That's the average. And ask yourself, I won't tell you the answer, ask yourself, how many years have we been going up? Have you figured it out? Okay. Who loves you, baby? Welcome to the Wheelhouse.